Now, this does seem like doom and gloom. Like I said, it's going to
Bring it
be
on.
so regional, but this is more of the same, more of the indication of a cool down in the multifamily market when it comes to rent growth. Rent growth currently is at 0.2%, and last year it was at 0.4%. So this is less than we need it to be. And I'm sorry, what was the other? So rent growth month over month is down, and rent growth year over year is still negative. I think it's negative 0.7% if I'm not mistaken, and that is still lower than it should be. And also vacancy is as high as they've measured it. So this, I think, of all of the reports that we get regularly, whether it's Yardi Matrix or RealPage or Redfin even, Apartment List has had the most pessimistic, or I mean, if you're a renter, the most optimistic take when it comes to affordability. They say that rents are going down. They say that rents are not filling up as much. Other sources, RealPage has charted improving occupancy. So I just want to signal that there is a degree of disagreement among these data sources. That's why I think, though, that Apartment List is valuable, because it's saying this thing that's a little bit of an outlier, and I don't want to miss the minority report. I want to know what happened from all these perspectives. And I think that there is a certain amount of validity to this Apartment List thing, because we've been seeing so much building. You can't build the most you've ever built, like they said in the State of the Nation's Housing, and not expect there to be an effect there. So what I did just want to signal here: you've got your high vacancy, you've got lower than normal rent growth, but you also have a large amount of regional variation that you can see in the map they have farther down in the So you can see still room for recovery in the Southeast, but Midwest, Northeast doing very well. Really, a whole along the South, just as was said in the State of the Nation's Housing, you still have monthly and yearly rent changes. So that's where they built. That's where they built more than half of all the new apartments were in these southern markets. And I'm not sure I don't think that that's balanced with the population. I'm pretty sure that there are more people living in the places where they didn't, but that's, I'll have to check that. I'll have to do the math there. But still, you're getting huge variations here. So metros with the slowest rent change, negative 6.4 for Austin, negative 4.7 for Denver. And then the metros with the fastest, the greatest year over year rent change, San Francisco at positive 4.9 and Chicago at positive 4.1. So that's a huge swing, man. You got like 5% and then negative 6%. That's a big difference, and I don't think these differences didn't crop up all at once, and they're going to be playing out for the rest of the year before things probably get into a more normalized, probably a little more even next year. But
what was that report we were looking at last week, Matt, that had Silicon Valley broken out as a top market?
Oh gosh, I forget.
It just reminded me of just how
maybe it was Avis and Young. Yeah, it was an Avis and Young report where all of their key markets were like the individual suburbs of Silicon Valley, Chicago, and Boston.
Yeah, it would be like us having Indianapolis and Greenwood and Carmel, and then select a South Sunbelt market and LA and Albany.
That's something that to be able to quantify this, it's something that I would like to chase down maybe in future reports, is to see, is there a way to look at all, put it in the spreadsheet and see, is the regional or market to market variability, how great is it now versus how it was pre-pandemic, how it was, and love to see how that shakes out.
Jay Parsons had an interesting episode recently on his podcast and talking a little bit about how what were considered to be the absolute core markets.
Is this the contrarian?
Yeah. San Francisco being one of them, and New York City. Now they're considered much more like risky markets and a very much contrarian plays.
Yeah.
Whereas again, those were the safe bets. And for big capital, it's sure, go buy an apartment building in San Francisco. I mean, the rents were crazy. It was continuing to grow. It was such a great city.
That's what I'm thinking.
But now it's
who's
the crazy? Yeah.
Someone's going to make a lot of money. Some people are going to be moving out of New York and saying, I don't want to invest there. There's someone that's going to make a whole lot of money building all the apartments that people need.
True.
And same thing with San Francisco. It's just a numbers thing. There's going to be someone.
The question is, though, I guess, is New York entering a negative cycle of where starting call in the 70s,
Yeah.
you know, it had to grow out of kind of a pretty dark place. And, you know, different mayors kind of with peaking at, you know, Bloomberg of where it kind of got better, where it's hyper clean, very little crime. And then, you know, things have just kind of deteriorated post-COVID. And the way we saw San Francisco transition from a really nice, clean place to some place that you didn't really want to travel, really bad issues of homelessness, you know, open, you know, air drug use, etc. You know, maybe that's just the meme and the stereotype, but you know, New York City, is it going to be a more dangerous place all of a sudden and a less desirable place because with free housing and free food. You know, what does that attract? And does that necessarily produce a prosperous, wealthy society, or maybe not a great outcome?
Maybe I'll live and eat there if the housing and food are good. I think that's it.
Yeah, that's the point. Not
I
you get what you pay for.
Well, but I also think there is and this is something that you mentioned earlier, is an emphasis in a growing amount of investor interest in the smaller cities, in the secondary markets. I think it was John Chang a few weeks ago talked about how the cap rates between the secondary and the primary markets are starting to, the gaps between the two is really shrinking because more people are just paying attention to places like Indianapolis versus New York.
Like, you know, when Kansas City, Columbus, and Indy are the new like core markets, you know, we'll take it, but it's definitely a change of conversation and if that is where the conversation is going, it's certainly a big change from the last couple of years. And institutions are just now, I mean, we've been talking about this for years, Matt, right? Institutions are just starting to wake up. And they're having to place capital. And all of a sudden, I'm just saying it now, over the next, not even like this year, over the next couple of years, there's going to be all these like really hot takes about how these like emerging developing markets in like the frontier of the Midwest are emerging, and no one else has heard of these places, and they're like, oh, I've got a really interesting, I was in Indianapolis the other weekend. Just wait for that. Just wait.
Have you heard of this place? It's called Kansas City. It's not even
Kansas.
A
state. I don't even know what state it's in, to be honest.
That's good.
Okay. Keep
so
going.